Great. Well, we'll get started. So good morning, everyone, and welcome to the final episode of Funding a Better Future vlog series. We do hope you've enjoyed the series so far. We're joined today by Clive, Jackie and Nathan, who are going to answer a few of the key questions that have been raised over the series so far, as well as any that you might have today. So use the Q&A box at the bottom of your screen. Ask some questions, and if we don't get to cover them today, don't worry, because we will follow up with you on them. So, use this time and ask some questions. And so Clive's going to just do a quick run through of a bit of a recap of what the vlog series has covered so far, and then we'll kick off with some of those questions that we've had in. If there are any sort of technical issues and stuff, we'll sort them. You can use the link in your joining instructions to get back into the session. But yeah, if you need anything, you can drop me a note. But let's kick off. Clive, do you want to just do a quick wrap up?
Yeah, thanks, Rebecca. Good morning, everyone. Thanks for joining us. So this is session 5 of the vlog series. We've previously covered off a potted history of public sector funding and financing going back several decades. We have covered off current models of funding through loans and grants, private sector JVs and alternative funding structures. And then the latter vlogs covered the collaborations in the private sector and those alternative funding structures, in particular, somewhat unusual structures or rare structures such as income strip arrangements, also CTLs, which are coming into play more and more often. So really, the intention of this Q&A is to allow people that have any questions coming out of those vlogs or any other questions in relation to this area to ask them of us, and we'll do our best to respond. We've also got a few questions that have come out of feedback we've had prior to this session. So the intention is we'll start on those, and then if people have any questions that they want to ask, if you could put them in the Q&A box, which you should be able to find at the bottom of your screen to open it up, those will then come through to us and we will hopefully be able to answer them, and if not, we'll do our best to come back to you at a later stage. So that's the general aim. We've got about half an hour. So I think, Rebecca, without further ado, shall we start off with the questions?
Yeah, we will. So Nathan, the first one we've got is for you. How are different models of funding treated by a local authority financially, capital or revenue, and are there any rules requirements pertinent to that treatment?
The key issue, I think, for local authorities in relation to this question about capital or revenue and how you classify things is quite important, because clearly whenever local authorities provide any funding, the key issue is always going to be which of those categories it fall into, because of course capital funding is more constrained than revenue funding. Now, I mean, typically the way in which you look at this issue and you decide which is you have to identify what's the primary function of the funding. So, for example, if the objective is for the purposes of investing to make some kind of return, then clearly that's going to fall within the powers contained within Section 12 of the Local Government Act 2003. And as a consequence, that will bring in all of the relevant guidance on funding that is contained within the SIPFA guidance, and also the Secretary of State's recently updated 1st of April 2018 guidance on how local authorities are supposed to invest, as it were. And clearly the implication of that is that it, technically speaking, will be capital expenditure, because of course it's the capital finance rules that will govern that arrangement. However, where there's a non-commercial purpose in mind, then the council can rely typically on its general power of competence powers contained within the Localism Act to provide that finance. And in this instance, that kind of investment will be treated not as capital expenditure. And the benefit of doing that is that you avoid some of the constraints that are associated with capital expenditure. But however, the sort of quid pro quo of all of that, and the downside is that you'd have to make some sort of provision for the, in effect, the capital element of that expenditure through what's known as the minimum revenue provision. So it's a bit sort of swings and roundabout, and by and large, I think the general tendency is to try and ensure that expenditure falls within the revenue count rather than the capital count, because it's far easier to manage and there are fewer constraints.
Thanks, Nathan. Jackie, next one for you. Are the government likely to create any more funds in the future? You're on mute, Jackie.
So I suppose as a starter then, it's got to be an absolute yes. If you go back to the government strategy, it's all about building back better, and the plan is ultimately for growth. So over the next 5 years, the government's talking about investing 600 billion in infrastructure, and this is probably to compensate for the underinvestment that's happened historically. And if you look at 2021 to 2022, there's going to be £100 billion of investment. So in vlog 2, we picked up on various forms of funding, and I mean, that was just a taster really. I mean, the funding doesn't stop there. There's various other funds. I mean, if you look at, say, some of the smaller funds, for example, you've got the UK Community Renewal Fund, and I think it's £220 million that's being allocated there, and that's open to local authorities who wish then to pilot programmes in order to meet local challenges that they've got. You've also got the Welcome Back Fund, and what that's aiming to do is help councils prepare for shoppers returning and tourists. And then you've also got the UK Community Ownership Fund, and what that is about is getting community groups who will buy or effectively take over community assets which are then at risk of being lost, and they run them as community-owned businesses. So those are some of the smaller ones. Then what you've also then got is some of the more substantial ones, and so you've got, for example, the UK Shared Prosperity Fund. That's expected to be launched in April 2022, and it's expected that that will be worth somewhere in the order of about £1.5 billion per year. Now, what the UK Shared Prosperity Fund does is it targets those places where it needs the most support. And what it's about then is supporting people, communities, and equally creating opportunities for regeneration and innovation. One of the other funds that we did pick up on in vlog 2 was in relation to the Levelling Up Fund, and that's a £4.8 billion sum. And the aim of that is then to support town centre and regeneration, together with local transport projects and equally cultural assets.
Thanks, Jackie. Clive, we'll go with one for you. How do councils decide which joint venture route is more appropriate for me?
This is the £1 million question, isn't it? So there's never really one shoe fits all, and the decision of the council depends on the risk appetite of the council, what the council's ultimate goals are, and so normally there's a sort of matrix of questions that they would need to answer for this sort of thing, and you know, sometimes councils or other public bodies will have thought of them. Sometimes, you know, there'll be new coming to the table on it. So, you know, start with the basics. What are the primary goals of the council in terms of the development or arrangement it wants to enter into? Critical is, are there timing issues? You know, is there a long horizon or a short horizon on it? And also, how flexible does the arrangement need to be? So, you know, for example, does the council want to enter into an arrangement with a JV partner where you can drop properties in as and when they're assessed in terms of certain criteria, or is it going to be a specific property? And based on those answers, you normally get to a point as to whether or not you're going to go down a contractual type JV, which is normally far less flexible, or if you're going to go down a JV route through a partnership or a corporate structure, which can allow you to put that JV in place for a long period of time, but also have flexibility as to the nature of the assets that go into it, how they're funded, and what the goals are on a side-by-side basis. So those are the sorts of things that need to be answered, and of course then there are procurement issues and funding queries. You know, is the council willing, does it have time to go through an appropriate procurement process? And obviously that depends on the nature of the scheme. And then secondly, how will funding under that JV arrangement arise? Is third-party funding going to be brought in from banks, or is it from the other JV partner? So those are the sorts of critical questions that need to be asked, and they'll generally all funnel down and then give you a very clear idea of which option you want. But normally you'll have one or two options.
Thanks, Clive. Nathan, let's go back to you. How do funding arrangements interact with procurement considerations?
Thank you, Rebecca. Whenever I'm faced or approached by a client who has some kind of investment proposal, there are sort of two major alarm bells that ring in my head. Number one is, are there any subsidy issues that arise? Is there a kind of state aid type scenario? To what extent is the authority effectively interfering in the market or not, as the case may be, for the purposes of bringing forward the said development? And clearly where it's acting as a market operator would act, then there isn't going to be an issue. However, where there is any kind of subsidy because you're dealing with some kind of public support for something, then yes, that does raise concerns. And it's something that you need to consider. The second major alarm bell that rings in my head is around procurement. To what extent is the authority in participating in whatever arrangements it has in mind, in effect, potentially entering into some form of works contract? Is it effectively procuring a public work, or is it simply acting as an investor, as an arm's length participant in a venture for some kind of financial return, rather than trying to secure some form of development either directly for itself in an indirect way, or indirectly by, in effect, specifying and identifying or trying to influence the form of development that's created? So those are the two issues. Now, most of the time, of course, with investments, that isn't going to be a problem, because, of course, it's purely going to be for some kind of financial return and would fit very neatly within the Section 12 type scenario I've identified. However, of course, if you're trying to fit it within the general power of competence, therefore it's likely that there will be some kind of public output that you're trying to create, and therefore it gives rise to the possibility of some form of, well, it may be the case that you will be creating circumstances where you are potentially creating some form of works contract by virtue of the investment. So they're the main things I like to think about. The key point, of course, is to flag them up and try and address them. There are ways of dealing with all of these issues, but you're not going to be able to do that unless you know they exist in the first place, which I think is the most important thing.
Just to comment on that one as well, Nathan. I mean, I think it's very important for people to understand that these decisions shouldn't necessarily be made in a vacuum in relation to just that scheme or development. Lawyers are really good at coming up with theoretical constructs just based around those exact facts, but you have to take into account wider considerations sometimes. So, for example, we've been involved on schemes to do with MSAs around the country, and when there's a chance for a new motorway service area, MSA, saying that it's normally a zero-sum game. There's normally only the ability to have one of those within a certain area on a length of motorway, and there will normally be a lot of competition for it. And so, one thing you've got to advise local authorities in those situations is, is it a theoretical risk of a challenge for procurement, or is it a real and present danger because actually there are people that will lose a lot? And the same can be said if councils are looking at urban developments and they have a site, but there are competing sites around the town centre. And as you said, there are ways and means of structuring it. You can have a property contract, or you can go through a procurement process. But I do think councils need to understand that these are decisions that need to be based on real world considerations in those sorts of situations.
Yeah, I agree. I think it's a matter of assessing risk in most circumstances and the magnitude of that risk, because it is a grey area. So I think you can quite comfortably reach lots of different kinds of conclusions based on the same set of facts.
Favorite area to be in, yeah.
Thanks both. Yeah. So the next one's for Jackie. Does the UK Infrastructure Bank offer anything new?
Right. Okay. So thanks, Rebecca. So just in relation to the Infrastructure Bank in terms of generally then, what that's intended to do is effectively replace the role that EIB had in relation to supporting major infrastructure projects. And all this in terms of, UK Infrastructure Bank being there, it fits in with the government's plans to deliver £600 billion of public sector investment over the next 5 years, which I've just talked about in the previous question. Now, at the moment, what's happening is the funding is being introduced in phases. So at the moment, it's only offered to private sector financing, and that came into place last month. But once it's actually fully operational, the intention is that it will invest in private together with public sector projects, and equally also provide some additional services. So I suppose going back then to your specific question, does it offer anything new? The core mission in relation to the UK Infrastructure Bank is to partner with the private sector and local government. What it's all about is increasing infrastructure investment, also helping tackle climate change, and also about promoting economic growth around the regions across the UK. Now, the bank's going to have at its disposal £22 billion of financial capacity, which will help it then deliver on its objectives. That's effectively split up into £12 billion of equity and debt capital. And also there's the ability for the UK Infrastructure Bank then to borrow from private markets. And then also what you've also then got is a £10 billion sum for government guarantees. So if you look at what will be offered to the private sector, you would have things like the senior debt. You may then have hybrid projects in terms of mezzanine loan instruments and things like that. Equally then equity together with the guarantees. If you then look at, what's in it for the authority, what is intended by the UK Infrastructure Bank is that there will be public sector investment, and what that will do is focus on making improved offers to people like the local authorities. I touched on previously additional services being provided by the UK Infrastructure Bank, and some of the things that this would include are things like helping address capacity gaps, also things like creating a forum for sharing knowledge, best practice together with expertise.
It's interesting on that one, Jackie, because I do wonder if in the end we'll start calling it, rather than the UK Infrastructure Bank, if we'll start calling it the UK Green Infrastructure Bank, and if the bent towards investment and the schemes it helps with, given it's got this second limb to help on the green agenda, if it will end up focusing on those schemes, or if people will approach it with that in mind. It'd be interesting to see how that pans out, actually.
Yeah, I mean, what I would say, Clive, in relation to that is that there will be a focus on particular projects, and some of those projects will include things like economic infrastructure.
Thanks.
Together with your things like the clean energy. So.
Thanks, Jackie. So the last one of the ones that we've had submitted beforehand, this one's for you, Clive. How can councils be certain the income strip will always be profitable?
Interesting one. I think the short answer on that is they can't. I mean, an income strip transaction, like any type of investment, has a broad spectrum of risks, and really councils and public bodies have to assess the risk profile of an income strip against other funding structures. I mean, effectively, an income strip creates a bond-like transaction where, in return for effectively forward funding, a public body pays a rent over the long term, much like it would under a bond. And so really the council or public body needs to be very clear as to the nature of the income strip, and there are certain things it needs to take into consideration there, such as what sector is it looking at investing or developing, where's the location of the asset being developed or invested, because if it's offices or retail or services, and is it in an urban centre or is it out of town? What is the length of the income strip investment? Are you talking about fairly short term, 20, 30 years? Most of these are 50 years plus, in which case you then got to think about both flexibility of use. So, what can the public body do with that asset? What is the intention and the goal of it? Can it change uses over time, because it's a leasehold structure, and investors obviously want to ensure that they get their return. But at the same time, the beauty of an income strip is that at the end, the asset reverts to the ownership of the public body, and so investors are less concerned about use to a degree. And the other thing is exit strategies. Can you get out of these arrangements early? Quite often there are lock-in periods, and then if you do get out early, there are expenses, much like break costs and early redemption costs in other structures. And then really, based on that, a council really should be getting professional advice, assessing whether it's appropriate or whether another form of funding is better. But can you guarantee a profit always? No, but you can certainly add in protection mechanisms to mitigate those risks.
Great, thanks, Clive. So we've had a few questions come in, so I'm going to move on to those now. And if you do have any, do drop them in the Q&A box. As I said, we will follow up on those if we don't get to cover them today. So let's have a look. Okay, one for you, Jackie. Jackie, do you think future funds will have a particular sector or strategic bias?
Right, okay. So that's actually something that Clive started touching on there. So just in terms of when I was picking up about funding previously. So just in terms of going forward, I do think that there's going to be a high level of government investment around economic infrastructure, and that's going to include transport, and that will be things like railways, roads, looking at those strategically, digital, broadband networks, as well as fund defences. The other thing then is that the government has issued a 10-point plan, and what this is involving is 12 billion pounds worth of government investment. And that focus in relation to that 10-point plan is about building back better, supporting green jobs, and equally, accelerating the path then to net zero. Now, in relation to the 10 points, just some of the examples are about advancing offshore wind, equally about driving new and more advanced nuclear power, equally about having green public transport, and also in that will include about walking and cycling. And I think probably one of the other ones as well is, protecting the environment.
Thanks, Jackie. Okay, let's take a look at another one. I think this might be for you, Nathan. In your experience, is there a greater risk of third-party challenge with any particular JV structures? You're on mute, Nathan.
Sorry, yes, that's an interesting question. Yeah, it depends really. I think from our experience, I think with obviously different types of structure have different risk elements to them. Obviously a JV, say for example, where you create a separate legal entity, there are ways in which you can construct that arrangement such that there isn't any public works contract type relationship between the contracting authority and the entity, because it's the entity that does the procuring. So there's an argument for saying that by creating that kind of once removed relationship, it is better than your conventional contractual JV type structure, because of course there's a direct contractual relationship between the contracting authority and the party delivering the work, services or supplies. So arguably a JV probably is better. And also the other advantage of a JV type structure, a corporate structure, where you create a separate entity. The other advantage, of course, is that in a sense, its activities evolve over time, so they're not fixed by virtue of the arrangements that are set within a contractual setting. Whereas if you have a contractual arrangement, it's quite clear precisely what it is that the developer party who's entering into the contract is to deliver. And so therefore, in a sense, it creates a much clearer line of sight to bringing some form of challenge, which I would argue is more difficult with a corporate JV type structure.
Thanks, Nathan. Got quite a few questions here. So we might run over ever so slightly. So if you need to get off at 10, don't worry. But we're recording this session, so we'll be able to share that. But we'll just might slightly go over. We'll ask a few more. Clive, in a contractual leasehold JV type arrangement, how can a council prevent the JV partner from implementing a non-acceptable scheme?
Okay, yeah, this is kind of questions asked fairly often because where you've got a contractual type JV, it's not quite often councils try to avoid or not deal with procurement by entering into a property contract where they'll be disposing of an asset on a leasehold basis. So, you know, but it's got planning, and obviously the council wants that plan scheme to come forward. So what can you do there to sort of incentivize that party without wandering into a works contract trap, as Nathan mentioned earlier on? So, I mean, there are a few ways you can do it, but you've also got to bear in mind that the other contractual JV partner in that arrangement will need funding. So, I mean, you could have break options in leases should schemes not be implemented within certain time, but you would need funded protection provisions there. The reason I say break options is because you could do buybacks, but a break option doesn't result in stamp duty, land tax liability. Whereas if you were buying it back, for example, you know, the scheme wasn't implemented within 2 years, there was a year left, and the council wanted to take back control to borrow a phrase from somewhere else, and then do something else on the site. If they used the buyback option, they would trigger SDLT. Obviously, in leases, you can put in place restrictive covenants preventing other types of use, the implementation of other types of development until certain types of development are done. You could also put in place approval mechanisms, you know, alterations clauses and the like in leases. You can put in place overage or anti-embarrassment type arrangements, which would stop people from trying to take advantage or changing the nature of the scheme, or at least give the council a share of any uplift as a result of the uplift in value. And if the other thing that we see quite often is if the council is retaining ownership of any element. So, for example, say there's some public elements to the scheme which they then want to let out or operate once the scheme's operational. You can put in place under leases at the point of grant, and what those do is albeit the scheme may not be complete at that point, it's almost a blocker like a charge, because if the developer wants to do anything with the scheme that's different from expectations, that lease is in place and they can't do anything without the consent of the council changing or bearing or surrendering that lease. So that's quite often a good mechanism. But in reality, you know, in a property-led transaction where it's a property agreement, you can't force the other party to do it, because then you're entering into a works type contract. And if you want that level of control, then you have to go down a procurement or route subject to certain caveats. So yeah, it's always a question that people ask when council say we're selling this and we want them to do this. But yeah, that's probably the best you can do without falling into a procurement situation.
Thanks, Clive. Right, we'll go in for one more question. I think this one's for you, Jackie. I think it follows on from your sort of question previously. How easy do you think it will be to obtain funding from the UK Infrastructure Bank?
Okay, so the bank are going to have certain principles that will need to be effectively, I suppose, achieved in terms of if funding is going to be provided. So one is about supporting the UK infrastructure in terms of driving regional and local economic growth, and equally tackling climate change. The investment then, it's all going to be around infrastructure assets, networks, together with technology. And also what's going to happen is that the investment will be expected to deliver basically a return. The other one is also, which is also on UK infrastructure investments banks' radar, is that they will expect there to be crowding in, with significant private capital investment over a period of time. Now, what the bank are doing, they will make decisions independently, and I think what they're going to have to do, and I think this is something that's being considered, is that there will need to be a framework that's applied for making decisions, and I get the impression that that's something that's being developed or has been developed. Now, just in terms of the kind of projects where the focus will be, I've picked up before when Clive mentioned it, but there will be more around economic infrastructure, and that will tie in with the National Infrastructure Strategy last year, and that will pick up on things like clean energy, transport, digital, together with water and waste. If you then look at the local government funding then that will come on stream later on, the intention is that will focus mainly on those sectors, or certainly broadly on those sectors. Now, what is clear is that there's certain projects that the bank will not be investing in. But I think ultimately, if you look at where the bank's focus will be, it is about investing in projects that wouldn't have otherwise happened, looking at taking forward this, meeting the net zero emissions agenda, and also just, focusing on, regional and local growth.
Thanks, Jackie. So I think we'll wrap it up there. Thank you so much to everyone for sort of listening in this morning. And if you've enjoyed the series so far as well, do sort of send us some feedback. We'll be circulating the full series after this, including this episode, which will conclude the series for now. But watch this space. I think there's going to be some more stuff coming down the line from the team. We've definitely had lots of appetite, lots of questions and things, so we'll definitely keep delivering sessions like this. So yeah, look out for the follow-up email where you can access the full season of the blogs, and we'll hopefully catch up again soon.